Hello and welcome to Asking for a Trend. I'm Josh Lipton, and for the next half hour, we are breaking down the trends of today that'll move stocks tomorrow. There's a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here are some of the trends we're going to be diving into. The Trump administration is looking to take on China when it comes to critical minerals. We've got the details on the new partnership that was announced Wednesday. And another commodity we're watching, oil. We heard from refiner Phillips 66 with results, and the company says it's ready for Venezuelan crude. Plus, we've got a look at some of the other names that are on the move after posting earnings on top of Alphabet and Qualcomm. We're breaking down those numbers. Well, the Trump administration is making moves on its critical minerals agenda amid trade tensions. Yahoo Finance's Washington correspondent Ben Werschkul joining now with more. Ben.
Yeah, Josh. So this is a new push on Wednesday here from the Trump administration to create price stability in the market for these critical rare earth minerals. Rare earth minerals, of course, are a variety of different products that underpin a lot of modern electronics. What Vice President J.D. Vance announced in a speech at the State Department was the goal is to create a new trading bloc, the U.S. and a bunch of allied nations, that will agree on a floor on the prices for these goods. The idea being here that this would give mining companies in the U.S. and elsewhere assurance that they could turn a profit when they eventually mine down the road. This is a multi-year process, and then that they would invest more capital in it going forward. As for how they're going to do it, what J.D. Vance said that the Trump administration answer here is around tariffs, as he called adjustable tariffs, basically tariffing imported rare earth minerals to raise the price to whatever level they decide this floor is going to be. This came at a speech at the State Department in front of a bunch of foreign ministers, 50 or so from around the world. Essentially, it very much felt like a sales pitch from Vance as he's trying to get these countries to sign up for this. Even the vice president, though, acknowledged that there was a significant skepticism in the room as to how big this trading bloc could be, how many countries would eventually sign up. But as Vance said, the U.S. thinks it's willing to go alone on this if it has to, but it's hoping to get as many countries as they can for this floor on rare earth prices.
Now, Ben, this is one of many events on rare earth minerals, right? So why the focus on this? And then, what other plans does the government have, on this that we need to have on our radar?
Yeah, it's been kind of a rare earth week here in Washington, D.C. with a bunch of events here, all focused on different aspects of this problem. Monday was about stockpiling. President Trump in the Oval Office announced what he called Project Vault, which is the goal of building a $12 billion government stockpile of certain rare earth minerals from a few sources. Today's event, the overall event, this was an all-day event, was focused kind of more on the supply chain side of it, essentially ensuring that these rare earth minerals can continue to flow into the United States. A third approach we've seen from the Trump administration in recent weeks is direct investment in U.S. miners, basically taking a government stake in these companies to kind of encourage domestic production of these, which they're hoping to ramp up. All of these are different facets of a problem, all based on one source, of course, which is China. China has really dominated this industry, as we've seen in very strong evidence the last year. Some estimates are that China controls 90% of rare earth processing capacity. That's the key bottleneck there. And so they have a stranglehold over this, and they've shown in the last year a willingness to weaponize it, essentially threatened to cut off rare earths to the U.S. and other countries in return for other policy goals. So the Trump administration is clearly making this a top priority, going through all these problems, although experts will tell you this is a multi-year process for the U.S. to build up its capacity. Also worth noting today that Donald Trump spoke to Chinese President Xi Jinping. No clear readout on the rare earth side of it, but Trump did talk about how important it is to kind of keep relations with the Chinese well for the time being.
All right, Ben. Thank you, sir. Appreciate it as always.
Okay.
Stick around. Much more Ask for a Trend still to come, including the latest edition of Goodbye or Goodbye. Welcome to Goodbye or Goodbye. Our goal here to help cut through that noise to navigate the best moves for your portfolio as investors rotate away from tech stocks. We're looking here at trades to watch outside of tech with Zacks Investment Management Senior Client Portfolio Manager. That would be Brian Mulberry. Brian, let's start on one you like, one you say is a buy. That would be Ulta Beauty. Now, this stock has had a great run. It's up about 70% over the past 12 months. You say, Brian, it's going higher. Let's go through the reasons why. The first reason you say it's a buy, attracted differentiated model. Walk me through what you mean by that.
So what that means is they have a really diverse line of products. They start at the base kind of mass-produced cosmetics, and then they work their way up to some of the luxury brands. Having that differentiation on the shelf in one spot for customers allows them to go into the place and decide when and where and how much they want to spend. They've done a great job of making those products available to consumers.
The second reason you say it's a buy, healthy consumer engagement.
This is just all about foot traffic. This means, again, the products that they have available at the price points that they're selling is gaining more foot traffic. When you're looking at retailers, brick and mortar, this is one of the most key components of growth. So that organic sales growth is showing up because more people are walking through the door.
And the final reason you say, yes, commit capital to Ulta, loyalty platform as a growth engine.
They're really taking care of those customers. That's what it comes down to. As they get more people into the store, they're rewarding them with this great loyalty program. It makes them show up more and more. They're capturing more wallet share. Again, that organic growth is the driver of the stock returns. We think there's a lot more to go for Ulta in the consumer discretionary model.
All right, you made your case, as always, Brian, eloquently. I'm convinced. Viewers may wonder, okay, hold on a second. Before you pile in, what's the risk I got to think about? You see, at the whim of consumer spending.
Yeah, in the consumer discretionary sector, you're always at the consumer wallet share, kind of threat, if you will. So if there is a capitulation in confidence in the economy, some of these luxury types of buys that consumers make are the first thing to go away. However, we see a pretty durable consumer out there. Retail sales growing up 3% year over year, and Ulta is doing a great job of capturing that.
Now, this stock is up around 70% over the past 12 months, but you must say, hey, you know what, valuation still attractive?
It's the trajectory of earnings growth. They are continuing to grow profitably, and that's why we still think there's room to run even in this stock.
All right, so you're buying Ulta. Let's get to one you say, you know what, I would avoid. That would be Arista Networks. You're not putting money to work in this one. Let's go through the reasons why. Margin erosion.
Yeah, this is an actual trade that we just made in our GROWS ETF, our large cap growth ETF, where we're moving out of technology, much like the market is. There's so much competition out here that it's compressing the profitability of their product. Now, Arista has this giant backlog of orders, but they're having a hard time pushing out enough compute to meet that demand, and it's hurting their pricing margins at this moment in time.
Second reason, you say this is one you avoid, high customer concentration.
Overly reliant on too few customers. They've got some really big contracts. It's a really big backlog of orders, but there's just too few of the customers. That makes us a little bit nervous in terms of concentration.
A third reason you would avoid, it faces stiff competition.
Again, that customer concentration base is under threat because this is an area of technology where there's so many people doing the same thing. That concentration threat is growing. Again, it all comes back to eating away the margin exposure because everybody's fighting over the same dollars.
All right. How could you be wrong here? Walk me through it.
So if Arista can actually clean up some of their supply chain and get back on track in terms of their margins and profitability, show that demonstrate that they are the best solution in this cloud computing space, they could actually unlock that backlog of about $18.5 billion in orders.
All right, buy Ulta, avoid Arista. Brian, as always, great to see you.
Thank you.
And thank you for watching and checking in, and for watching, goodbye or goodbye. Stick around, much more Asking for a Trend still to come. Phillips 66 posted a strong quarter in earnings. The company saying strong demand and wider heavy crude discounts helped by Venezuelan supply dynamics are lifting margins. Yahoo Finance executive editor Brian Mulberry sat down with Phillips 66 CFO Kevin Mitchell to break down the earnings report.
So yes, a good quarter both on the operating and financial front. We generated, in fact, third consecutive quarter of strong operating and financial results. We had record performance both in our refining and our midstream business, record NGL throughput, transportation volumes, as well as fractionation volumes. Refining ran at 99% utilization and generated record clean product yield. So we feel very good with all the work we've put into helping enable us to generate results like that.
A lot of the contacts that I'm able to catch up with, Kevin, that cover your company, they give you credit for cutting a lot of expenses, really focused on margins right now. What will get margins higher in your business as the year progresses?
Yeah, so we're pretty optimistic on the overall demand outlook, especially in the refining business. We continue to see strong demand fundamentals. We also are, as you point out, we are a margin business. And so it's both the cost of our feedstocks and the prices for the products we make that really matter. And with what we're seeing in Venezuela and more heavy crude coming to market, we're a large consumer of heavy crude across our system. And so that widening of that heavy crude differential is a benefit to us as well. So that's another margin uplift for us.
Before I get to Venezuela, what is the state of that chemical business? Has that bottomed from a margin perspective yet?
Well, we hope it's a bottom. So we're in a tough spot in chemicals. We're in a somewhat of a cyclical trough. Fortunately, from our standpoint, our chemicals business at CP Chem is focused on the low-cost operations. So Gulf Coast and Middle East presence predominantly, low-cost feedstocks, low-cost ethane supply into those facilities. So even though it's a tough time, they're still profitable. They generated $145 million of EBITDA for our share in the fourth quarter. So even in this time frame, we still feel optimistic over the long term about that business and the long-term supply-demand fundamentals.
For those not really in the trenches on this issue like you all are, Kevin, what does a resumption of Venezuelan crude, what does that mean to the U.S. oil markets? And then what does it mean to oil prices here in the country?
Yeah, so just to be clear, we don't produce oil and gas. We're a consumer of crude oil in our system. And more Venezuelan crude means more crude supply in the overall markets, but specifically more heavy crude supply. And with our significant coking capacity we have across our refining system, we consume a lot of heavy crude. With more of that supply into the market, then that puts some pressure on those heavy crude differentials, which we're able to benefit from. And so that's beneficial to us and those like us that have that refining upgrading capacity.
Do you see, is this the year that supply and demand become better in balance?
Yeah, I think so. I mean, we saw some good supply-demand trends in the second half of 2025. And as we look into 2026, we remain pretty optimistic, barring any major jolts to the global economy. We're pretty optimistic that the demand trends are going in our direction. And in terms of new supply from a refining standpoint, relatively limited. Back
on Venezuela, Kevin, how long, there's been debates on how long it will take to actually get this oil flowing again on a consistent basis. Of course, Chevron is one of the main players in there. But will it take decades?
Well, it's hard for us to answer because we're not directly in that business. I do think it will take time. I don't think there's any immediate uptick in production, and there's a lot of work that has to be done in Venezuela to bring that crude production back. I mean, as you know, they were at 3 million barrels per day or more back in their peak, but that was quite some time ago. And so it is going to take a lot of time and investment to get there. And we, from our standpoint, we are ready to consume that crude or similar crudes through our system.
What is of course, you've seen these comments from Exxon CEO. He called Venezuela, quote, uninvestable. How do you see it?
Well, fortunately, we don't have to make those decisions. Given the nature of where we are, I can understand the challenges going into a country like that where you've already been expropriated in some cases more than once. So clearly there are challenges, but there's also a lot of interest. It's a huge oil resource that's available in that country. And so it's natural there will still be a lot of interest in getting a stake in there.
Getting so many different economic reads, Kevin. I had a good conversation yesterday with PepsiCo's CEO. They're focused on lowering prices to make things more affordable for consumers. But I think about your gas stations that you operate. I mean, what's your read on the U.S. consumer at this point in the economy?
From what we see, the consumer economy has been doing fine. Gasoline demand has held up. Diesel demand has been strong. In fact, we saw some growth in demand for fossil diesel, partly because of some of the challenges on the renewable diesel business. And so our view into the economy through that lens has been quite positive, which is part of what informs our relatively upbeat outlook as we look to through 2026.
You think gas prices have further to fall?
That becomes a pricing call, where the crude prices go, what happens on the margin, the refining margin front. So it's a hard one to predict. I mean, we focus on that margin, and there are a lot of dynamics at play. This is a supply-demand balancing on a global basis is what drives this. And so there are factors that we just can't really have control over, and that's the important point. We're focused on those things within our control, which is operations, reliable operations, safe operations, managing our cost structure, and helping get product to market at what's our lowest cost possible.
Taking a look at some after-hour movers now. First up, Snap. Snap reporting better than expected fourth quarter earnings and adjusted EBITDA. Company also announcing its board of directors has authorized a stock repurchase program up to $500 million. Repurchases under this program will be funded from existing cash and cash equivalents. Looking ahead, company sees revenue of $1.5 to $1.53 billion. That's just shy of expectations. We're also watching Ulta Beauty. That stock is soaring after the company's third quarter results topped expectations and raised its earning guidance for the full year. And the outlook beating analyst estimates. The company's CEO saying he's confident in growing market share further, and that was behind the raised outlook. Finally, check out shares of ARM Holdings, the chip designer under pressure. Even though third quarter earnings beat expectations, the company's fourth quarter outlook also failing to excite Wall Street. And that's been the theme for tech stocks thus far this earnings season. Results from Qualcomm also not helping sentiment. That company providing guidance that failed to meet Wall Street's expectations amid memory supply constraints. Well, that's a wrap on today's Ask for a Trend. Be sure to come back tomorrow at 4:30 p.m. Eastern for all of the latest market moving stories affecting your wallet.